So this is determining the cash flow estimation for a replacement project. And they're more complex to do because you have to consider what cash flow is without a replacement, so before or if you don't do it, and then also what it is with the replacement, and then what you're doing is calculating the difference. So the first part of this particular problem shows where we would be if we didn't do a replacement. So our revenues, our costs, except for depreciation, in this case, straight line depreciation is being used $100 per year. And so we accumulate those two as our total operating cost, subtract that from the $2,500, and we have $1,400 per year as our cash flow. Taxes are 40%, so 40% of the 1,400 is 560. And that's subtracted off to give you your earnings after taxes of $840. And then just like we've done with an expansion project, you add back your depreciation, and so your cash flow each year is $940. So then we consider what happens if we do the replacement. And they have a new machine which has a value which will cost you $2,000. They've already done the calculation, and the after-tax salvage cost on that old machine is $400. So you're out negative $1,600 in year zero. Of course, before there was no outlay in year zero, so that's different. Sales revenue is still $2,500. The costs are much lower now. They're only $400, which is why they're wanting to replace, is to save some money in their expenses. And then their depreciation, using accelerated depreciation, and I can show you that. Over in a little different part of the spreadsheet. Maybe. Okay, so here's the new machine and the depreciation on it. So it's been calculated over here. So here's the depreciation on the new machine: 660, 900, 300, and 140. So we add together the 400 and the 660, and these are our costs for the 4 years. So subtract the cost from the revenue and get the net operating income. Apply 40% in taxes again to the income. Subtract that in order to find the earnings after taxes. And then again, add back the depreciation. So now you have the cash flow after taxes and after the depreciation. So this would be your net present value line if you weren't doing a replacement. But because it's a replacement, we need to net these numbers with the numbers that were used if we didn't do the project. So for instance, we add 940, we take away 940 from 1524. So this is where you're at, but you lost the 924. 1620 less than 940 gives us 680. And then we evaluate the project with net present value, internal rate of return, the modified internal rate of return, and the payback. So this is kind of a complex way of doing it. A lot of times you can just simplify it and only consider the incremental or differences. So in this case, the only differences are going to be that we are out the 1,600. That's still the same. The savings on our expenses, they were $1,000 per year. Now they're $400. And then we take that and calculate out how much that actually saves us by taking that number times 1 minus the 40% taxes. So it's actually 60% of it. And then we calculate the depreciation. And we're only looking at the difference. So this is the difference each year with depreciation. We have the new depreciation, which helps us with our taxes. But we lose what we had on the old machine. So, and then we take that number times the tax rate, so 560 times 40%, and then we can accumulate those numbers. And those numbers are exactly what we found up above by doing the long spreadsheet, but you would find exactly the same numbers here.